Hey, good morning, everybody. This is Angelo Christian coming to you today on FHA loans. The purpose of this broadcast, this webinar, is to educate people on FHA loans, to go from the beginning to the end, to teach people about, everything that I know about FHA loans from the origination to closing of them. FHA purchases, FHA refinance, streamline, FHA cash out refinance, and FHA 203B escrow repair. FHA loans are approximately 60% of the loans that we originate, the bread and butter. And when you come in here to work, you really need to know about what FHA loans are, so that way you can master the business. And so, real quick, we've got a few different slides here today to talk about it. From the inception about what FHA loans are, and then go into the guidelines and some of the different products so you can master it quickly so you are successful with the program. And so getting down, understanding FHA loans and USDA loans, they comprise both of them about 90% of our business. So it is very important that you understand them. And when you come in here, really the main thing that you need to focus on first when you're starting, not just from the selling aspect, but also on how to structure and package a loan for processing and underwriting, so you can get your deal closed, get it in, get it out. And so a lot of different aspects that are involved with that. Basically, FHA loans, just pull up some information on the history. Kind of pull up and see kind of a little bit of brief information about in Wikipedia what they are. And so basically in the Great Depression is when the Federal Housing Administration was created, when all the bank debacles, everything kind of went very crazy, and banks weren't making loans. And so a lot of houses were foreclosed, billions of dollars were wiped out, and essentially, in 1934, the federal banking system restructured, and the National Housing Act was created through the Federal Housing Administration. And it was basically a stimulus for housing, to boost the economy. And so, and you can read all about that on Wikipedia. But basically, what the FHA does, they are essentially an insurance company to the lender. They're insuring the lender to make the loan. That's why it's called a government loan program. They're not making the loan. They're not doing the loan. They're insuring the lender to make the loan. In the event of foreclosure, the lender gets paid off usually anywhere from 75 to 90% of the funds that they lent will be paid back to the lender. And so it gives people the opportunity to be able to buy a home with little to no money down, low interest rates, and you don't have to have the best of credit. So it's a phenomenal opportunity, because regular bank loans require 20% down. And so, you can get a low interest rate and even have a poor credit score and still get really good financing terms. So definitely, I encourage you to read up more about it. And so how the FHA stays in business is they're an insurance company. I mean that's how I look at them. Probably other people look at them differently. But that's how I see them. And I know they have other roles and stuff like that, but it's basically how my interpretation or understanding of what they do. So they provide a lot of money to the Treasury, and about $400 million a month to the Treasury, about $5 billion a year. So how do they make their money? How does this all work? Well, they charge premiums, just like your car insurance, just like your homeowner's insurance. And so with with an FHA loan, the way it works is so they charge 1.75, if I can write today, 75% of the loan amount. Okay. So if you buy a $100,000 home, okay, equals 1750 you have to pay the FHA to get this loan. But don't worry, it rolls into the loan. You don't have to pay for it out of pocket. So it's $1,750, 1.75 multiplied by a $100,000 loan, not by the purchase price, by the loan amount. And so it's $1,750 gets financed into the loan for you to get this loan, okay? Because it has special incentives. One of them is that your closing costs can be included into the loan. And so and we're going to talk about that, so don't worry. Now, in addition to the upfront, this is called an upfront mortgage insurance premium. There's also a monthly mortgage insurance premium, and it stays on there for the life of the loan, okay? So it is 0.85% of the loan amount, okay? So if we're dealing with 100K, and that's every month you have to pay that. So you take 0.85% times 100,000, comes out to, let's see here, $70.83 a month. They have to pay for the mortgage insurance premium monthly. Okay, so, and that's for the life of the loan. With FHA and USDA, you have to pay the mortgage insurance for as long as you have the loan. Now, you can always refinance an FHA loan into a conventional loan and have opportunities to remove the mortgage insurance later on. But that's basically how the FHA stays in business. Now, like I said earlier, if the FHA, if the homeowner goes into foreclosure, the FHA pays off the lender for the money they lent. So that's how that works. All right, so let's get through this, and we can go through some of this training. Let me close some of this out. People emailing me all the time. So FHA guidelines, we're going to first talk about a couple things here. Eligible properties. So single family homes. Whoops, that's too big. You make that smaller. I don't like the blue. Okay, let's just pull with all this. Single family homes, townhomes are fine, condos are fine, but it has to be FHA approved. And there's an FHA website that you go to, and it's right up here where you go to. It's you can just Google this. You can Google FHA approval condos, and like you literally just type in, like, let's just say we're in Houston, Harris County, and you want to type in Houston, and I just want to know the status of approved, okay? And then you hit send. Oops, I didn't put the state. That might be important. And it'll tell you if the condo's approved or not, okay? Oh, it's closed. Great. So this, maybe it updates in real time, but basically you go in here. We have another video about this, by the way, but you go in here, you type in, the city, county, state, and they'll tell you if it's approved or not. Be sure to check approved. Now, if it's not approved, they can request an application to apply from this website, or if it's been expired, they can request a renewal, but that takes time. So just be sure if you're doing a condo that it's approved on this list. Now, if it's a freestanding condo, then it doesn't have to be go through this process, because a freestanding condo is considered, like a single family home. So that's okay. All right. So condos, fine. Check the website. Duplexes are fine. Duplexes, if they're occupied by another tenant, typically, that can be okay, but they may want to, if you haven't ever had any experience leasing out homes before, then they're going to want to see that maybe you have some extra reserves, and sometimes you can even use the income from the tenant that's occupying that home to qualify. So you definitely want to check with your underwriter or your manager to find out, if you can use the income from the tenant of the duplex to qualify for qualified income for you. And that's a really good test question on tenant income for qualification. And then you can go up to 4 units. Okay, 1 to 4 unit properties. Properties cannot be income producing. So when I'm talking about income producing properties, I'm talking about real basic understanding of that. This is income producing. Okay, that's income producing. It says, well, I want to buy, a home that, has all this stuff on there where it's generating income, with wildlife, there's all kinds of different things going on. There are too many outbuildings. It's not going to work, guys. We lend on single family residential, all this kind of stuff, a bunch of cows and stuff like that. It's just not what we do for the type of loans that we lend on. And so it can't be income producing. And agriculture exemption is fine, but it can't be income producing. So if the guy has an agriculture exemption, maybe has 1 cow on there or something like that, or an acre of corn or something, that's okay for his personal use, but it can't be income producing. So just understand that. Mobile homes, we do them, but we really don't want to do them. Minimum $250,000 loan. It does have to be a double wide, built after 1978. No single wides. Has to be on a permanent foundation or pier and beam. Mobile homes are considered manufactured homes. Don't confuse the two, okay? Modular homes are fine. Modular is considered a single family. The modular is always okay. Construction loans, we do construction loans, but that's a whole separate course. For construction and renovation of mobile homes, you have to take courses to get approved to offer them. But if someone's inquiring about a construction loan, send that to a senior loan officer. The minimum that we can do on them is $330,000. Okay. Excessive acreage can be okay as long as you have comps within the last 6 months that are comparable to the subject property. So let me explain what that means. So let's say that, excuse me. Let's say that you have, let me just pull up a home for sale here, like, homes for sale. To kind of give an example. So, okay. Okay, you see here, these are in Humble, Texas. 4 bed, 3 bath, 3,000 square feet, $269,000. You move it a little further down. We want to find comps that are similar. That means homes that have sold, not listings. Homes that have sold that are similar to this. Okay, they have to be similar to this. So something like this down here. It's going to be something that's this is not similar. There's too big of a variance in the square footage. 1797 square feet versus 3250. It's almost double. So that's not a good comparable. This one's an okay comparable. This one is more realistic right here. So if you're doing excessive acreage and the guy says, well, I want to buy a house with, I want to buy a house that has, 50 acres on it. I want a house with 50 acres. Then the comparables have to have that much land too. If the houses all around there only have 1 acre, it's not going to work. Okay. If the house that he wants to buy is only a 1 bedroom with 20 acres, then you better find comps that are similar to that, or the deal's not going to work. Okay. So, and you can talk to the realtor that's involved in the transaction to see if there's comps, or you can talk to the, the buyer, obviously, and you need stuff that have sold. The other thing that's important is the proximity. How close are the comps to, usually it has to be within a mile. If it's in a rural area, maybe you can go to 10 miles, but it can't be, something stupid like 100 miles out. Okay. So this is very important. And the reason why is that when you're appraising something, it has to be similar to determine the value. Because when you're doing a loan, you can't exceed, the financing. The loan can't. The way it works with FHA is, it's 96.5% of the value is what we lend to, or what they allow to. Right? So if you buy $100,000 home, you're putting $3,500 down, you're financing $96,500. So you cannot finance more than 96.5% of the value. So it's important that you have the value of the property. We'll talk a little bit more about that later. So anyway, we're going to talk about some requirements and talk about credit and everything like that too. It's real important that we understand this. So moving along, some of the things that FHA loans, they have loan limits. You just can't lend to infinity. So and I'll show you a quick resource where you can check where the FHA loan limits are. If you go here to one of these resource websites, let's just click on, let's just go, I guess if we're in Texas, let's just go to Texas. And it has all the different states here. FHA.com lending limits. And boom, pull up all the different states or different counties with the income limits. And so if you look here, kind of like in Anderson County, for a single family home, it's $271, a duplex is $347, a triplex is $419, and a fourplex is $521. And these change; they're different all over. So it's not going to always be the same with every area. Actually, let me pull this up. I'll show you. All right. Let's see here. Just trying to fix something real quick. I think I did something. I'm trying to find out what I do with the whiteboard. Sorry, guys. Let me see. I accidentally deleted the whiteboard. So anyway, found out what I do. Nope. Okay. Okay. Let me see here. Oh, there it is. Okay. So I just want to turn it off. Okay. So yeah, sorry about that technical difficulty. Yeah. Yeah, Houston, higher loan amounts, and obviously if you go into Austin and stuff like that, bigger loan amounts down here. So, and so there are loan limits. So what does that mean? Well, so you can't do a loan for someone in, Austin County for $500,000 for a single family home, if the loan limit is 330. Okay. It doesn't work like that. No, they could still do the loan, but they'd have to put the money down. So, if they're going to buy a home for 500,000 and they want to, you either do a jumbo loan or conventional loan, a different product. You probably want to do FHA. That just means that's the limit they can go to. It doesn't mean they have to spend 330. And so the math is that now that's the loan amount. That's not the purchase price. So simply, if we go back, so if they're buying a home for 350,000 minus 3.5%, equals 337K, 337,750. They're exceeding the loan limit. So they'd have to put more money down to get below the loan limit. because the loan limit was 330, so they have to put an additional 7,000 down. So that's how that works, the loan limits. Couple things so if you're in a community property state, and basically community property states are as follows. Let's take a look. And we have a list. We have this on our training for you on your matrix. I think it has it here. Just want to show you real quick. Maybe it's not. Maybe it's not on here. Okay, here it is right here. So yes, in the states of Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, and Wisconsin. These are community property states, guys. So that means that when you're buying real estate, anything that you purchase, your wife or spouse is also going to go on the deed and the title with you. And when in terms of getting a loan, why does this matter? Well, so with respect to a government loan, like an FHA loan, when you're married, and let's say that for whatever reason you don't want your spouse to go on the loan because of credit or whatever issues, so we still have to pull, when you're doing a government loan, only a government loan, not a conventional loan, then we have to pull the credit of the spouse and include their debts into the debt ratio. Their credit scores are irrelevant, but their debts have to be included. And so, and that gets factored into the debt ratio. Let's say they say, hey, Angelo, I don't want my wife to go on the loan. She's got really bad credit. She's got all these collections and student loans and all that. And we're here in Texas, and you say, well, I understand that, sir, and I get you. I'm in a similar situation myself, but when you're doing a government loan in a community property state, we have to include your spouse's debts. Now, her score doesn't have to go on the loan. She doesn't have to go on the loan, but we have to include her debts. So you will need to do that if you're doing a government loan. Okay, and that does that. If she has collections, she has charge-offs or other loans that he doesn't have, then those get factored into his debt ratio with his income only. You cannot use their income if they're not going on the loan, but you would have to use that. It's called an NPS, non-purchasing spouse's debts. So they do get factored into the debt ratio. So that's an important thing to understand. Another thing is, so check that list to make sure if you're doing an FHA loan or VA or USDA, if you're in a community property state. Real important question or a thing to learn. FHA is for primary homes only. Okay, for primary homes only. For primary occupancy. So you can't use FHA for investment properties. You can't use FHA for a secondary home that you want to live in. It has to be for a primary home. So, if you're selling your existing home and you're going to be buying another home, that's fine, but your existing home has to be sold prior to buying the new home before closing. So you can get pre-approved with the contingency of selling your current home and before buying the new home. That's fine. We can pre-approve you for that. And then once you want to put the offer on the new home, that's okay. But you can't close on it until we have you've sold and closed your other home. So now if you get let's just say that you get transferred from your job, and let's say that you're like here in Houston and you get transferred to Dallas, Well, you can retain your existing home and lease it out and then purchase. And let's say that's an FHA loan here in Houston, um, and you can't sell it in time, then then you can lease it out if you need to, and then purchase the home in Dallas and have a second FHA loan. So that's fine. So that's a really cool thing that if that happens, that a way to, but it has to be over 100 miles. So obviously Houston and Dallas is 100 miles over Houston. So that should be really helpful for you if that situation comes up. It does have to be over 100 miles though. On um, So FHA flips. This is an important thing right here. If you got to find out when you're doing a deal with the realtor, the buyer, and the seller, FHA, it's prohibited um, that we do a loan where the seller is selling the home where he just has taken title to the property less than 90 days ago. So if he bought the home, a month ago and is turning around and selling it, we can't do that with FHA. It'd have to be a conventional loan. He has to wait at least 90 days from the date he took title to the property to sell the home with an FHA program. If it's 90 to 90 days to 180 days, so 90 days to 180, then we have to order two appraisals and to get two different comparisons, and they go off of the lower of the two appraised values. So if you have one house that appraised for 100,000 and the other one appraised for 90, we have to go off of the lower of the two appraised values. If he's took title to the property between 90 to 180 days, and he's selling the home, to our customer. So just keep that in mind if that comes up. Couple other things that with FHA loans. FHA loans are for U.S. citizens. U.S. citizens. Oops. A permanent resident. I'm just going to put perm res. And if you're here on a work visa, okay? So U.S. citizens, permanent resident, and a work visa. Now, if you're here on a work visa, you have to have 2 years of U.S. tax returns. And sometimes you might be able to do less, like 1 year. We have to check with the underwriter to make sure. But these are the requirements for getting an FHA loan. So if you're here, under any other circumstance, illegal or TIN numbers, and you don't have a work visa, then we can't do an FHA loan for you. All right. So these are the requirements. Is the work visa with preferably 2 years U.S. tax returns, permanent resident, and U.S. citizen. So that's an important thing. A couple things when you get an FHA loan that's very, very important. You need to have a conversation with your customer about the funds for the down payment. That all has to get figured out up front when you're doing an FHA loan to make sure that you know and you verify where the money for the down payment is coming from. Because with a government loan, the down payment money must be sourced. So if he tells you in the beginning, yeah, Angelo, I got the money, I'm going to get the money. Well, we need to know where it's coming from, and we have to document it. So in our business, what we talk about is trust but verify, measure twice and cut once. So you need to see where the money's coming from. And so if it's coming from a gift from the dad, then we need to see there's a gift letter that we provide that the father will fill out on why he's gifting the money to the son. And we need to see copies of the check that he writes to give to the son, and we need to see the dad's bank statement and the son's bank statement to prove it. Okay. So, and so that's very important this is a very transparent business. You can't, or industry, especially when you're dealing with the government, you can't hide anything. And so just make sure that you hash all this out up front, because here's the thing. If you don't get this stuff addressed up front and you turn your loan to processing, it's not going to close, guys. This has to be addressed up front by the loan officer to make sure that it's taken care of. If it's not taken care of, your loan will not close and you will not make the money that you think you're going to make. You have got to have this conversation and deal with this up front with the buyer. All right. And they have to understand that up front. However, they're going to get the money. If it's cash, it's got to be put into their bank account, season that account for at least 1 month. Okay? No cash. Okay? Must be in bank account for at least 1 month. Now, there are some acceptable things. If you have payroll deposits, we can use those immediately. If you are getting a tax refund, you can use that immediately. If you've sold something, the only things that are acceptable that you sell is something, basically that can be tracked like a vehicle. Where there's a transfer of title, you need evidence of a transfer of title, and a bill of sale, and showing the money from the account leaving or going into your account, and the transfer of title. Selling a couch is not going to work because there's no paper trail. Potentially, if you try to list something on eBay and you sell it on eBay and you show the transaction, there's a paper trail that could potentially work, but there has to be a transparent trail showing the sale, like a chain of title with a car, and possibly showing the Kelly Blue Book value of the vehicle. So, and showing in your account. So this is very, very important to understand when you're doing an FHA loan. So the other thing is that any deposits over $500 must be sourced. So what does this mean? That if they have deposits in their bank account that are over $500, we need to know where it came from. The underwriter is going to ask, and we're going to have a plan on how to respond on where that money came from. So, and if you're using that for closing, and then it definitely has to be sourced. They want to know where that money came from, and you have a letter about that to show where the money came from. All right. If you can't source it, we cannot use it. So just make sure you understand that. So that's a really important thing. We're going to talk about some other stuff later about sourcing money for down payment and different things, but that's some basic things that are required. Let me go back up here for a second. Okay. So there are different types of loans, like I was saying earlier. There's FHA escrow repair, and we're going to talk about these in detail. FHA streamline refinance, FHA cash out. We're going to talk about all these different ones in depth. Couple things. Let me just kind of show you the different terms that they use for FHA. So yeah, there's a the FHA 203B is the common and most widely known program. It's the FHA 203B. I don't know where it got this name or how it did, but that's pretty much for any purchase loan that we do, any refinance is an FHA 203B. All right. And you can read all about it here. It's for basically for any purchase, refinance cash out. There are other types of FHA loans, like the FHA 203K. And this is a renovation loan. I was just going to pull something and see if I could find something quickly on it. No, I don't want to go there. And there's two different types of FHA 203Ks. There's a streamline and there's a full. We're not going to talk about that today because that's you have to get certified to offer those. So we're going to focus in just on the FHA 203B. And we're going to talk about, take a look at some credit reports and stuff like that and go into, let me see here. We got condominiums out of the way. Okay, we got a credit report right here. We're going to go into the some of the underwriting guidelines and things like that. So let's see here. All right, this is when you start working here, you're going to receive this product matrix, and I'm going to let's minimize this for a second. All right. And basically it shows all our different programs and products. Today we're just focusing on FHA, and we're going to talk about it in detail now about some of the guidelines for debt ratio and credit and income and all that. So let's see, I think you guys, let me just zoom this up a little bit. All right, let me fix this. Okay, make it easier to see. I think that's better. All right. Okay. So with FHA, we go down to basically a 600 credit score. There's different tiers: tier 1, tier 2, and tier 3. So these are the debt ratios that you can go up to with FHA. And there is a front end, which is your house payment, and the back end, which is your cumulative debt ratio with all your debts. Okay. And so these are guidelines. These are not hard and fast, but to kind of give you an idea of what these percentages, what they stand for. So there are no income limitations for FHA loans. It's not just for first-time buyers, by the way. Anybody, current homeowners, first-time buyers can use FHA. And so, but basically, going back to the ratios here for the front end, what this means is that if let me go back to, so the front end debt ratio, if somebody has between a 600 to 619 credit score, this means that their front end, their house payment cannot exceed 35% of their income. Okay. Now I'll tell you this: if somebody does have a 600 619, we always want to try to rescore them to get their credit score at least at 620 to get a better interest rate, easier underwriting. The higher the credit score, the better interest rate, the easier underwriting you're going to get. We really don't want to turn in a loan with a middle credit score between 600 to 619. And also, when in mortgage lending, just FYI, we go off the middle credit score. It doesn't matter if it's with TransUnion, Equifax, or Experience, the middle credit score. And if there's two borrowers, it doesn't matter who's the co-borrower or the primary borrower, they go off of the lower of the two credit scores, okay? So it doesn't matter who's first, who's second, they go off the lower of the two for the underwriting. So well, basically, how this works is, just to kind of give an example, if somebody's making the income. It equals, let's just say, 5,000 a month. Then their payment on the house can't, with taxes and insurance, if it has a HOA and mortgage insurance, everything cannot be more than 35% of that. So if they're making 5,000, you multiply it times 0.35%, and their house payment can't be more than $1,750. So it has to be, less than less than or equal to. Give me 1 second, guys. Okay, 1 second. No, you can wait over here. I'm just doing audio or video. Okay.
With me? Yeah. I always do on this side. No, wait. I'll tell it.
Were you in your room? I couldn't tell which room it was. The windows were tinted, so I can't see.
It's okay. All right. So anyway, if the front end debt ratio, can't exceed 1,750, less than or equal to 1,750. Okay, and that's all in with property taxes, insurance, everything. Can't exceed that. So just keep that in mind. Now, obviously, if you go to a higher credit score, then you can go up to a higher debt ratio. Okay. And the higher the score, the higher debt ratio tolerance. So you always want to try and get the score up if you can. So that way you can, get a better interest rate, a lower rate, and easier underwriting, also to get a DU approval, which is desktop underwriter, which is our underwriting approval. The minimum loan amount that we do, basically, is we really don't want to go. We can go lower. We can go to 50,000, but 60,000 or higher. Now the back end debt ratio is with everything included. That's with all your debts that are reported on your credit report. And so this is with your new house payment, and your debts that are reported on your credit report, not your rent, but these are the back end total debt ratios that we use as guidelines. And so it's real important to make sure that we're following this. Now, a couple things here that we're going to talk about. For how do you determine the taxes and insurance in an area? Well, what we do for insurance is we have this little thing right here as a guide for HOI homeowners insurance. We normally use 0.75 of the loan amount. It's not 100% accurate, but it's an estimate, and you want to check with the seller or the realtor to find out, or the home buyer, or have them get an insurance quote, or we'll get an insurance quote to find out how much the insurance is and the taxes. Never quote a payment with taxes and insurance. Find out what those rates are from the seller or the buyer or the realtor. you only quote a principal and interest payment only with the going rate, which is at 3.25 today, for a 30-year fix. Let's see here. What else? This is a really good matrix. Make sure you study this all the time. I want to make sure I have the right information here to give you. Okay. So we said, what is DU? DU is desktop underwriter, and basically, let's kind of pull up so you can see what is. It's an automated underwriting system to determine, loan qualification through Fannie Mae or Freddie Mac or FHA guidelines. Okay, and you can read all about it here, and I encourage that you do. But all the loans that we do for FHA, conventional VA, they get run through DU, desktop underwriter, to determine what the loan qualifies for. And you're looking for, there's different responses that you can get from desktop underwriter. There's approve eligible, refer eligible, or refer with caution. There's also approve ineligible. That's probably you're not doing something right that you can fix. So you want to get, obviously approve eligible, because that's the one that you're looking for. That means that basically the computer has approved the loan, and that's what you want. You want DU to approve the loan. A refer with caution means that that the loan's not going to get approved, and we cannot do it. You may be able to tweak some stuff to fix it, or change some things with assets or reserves in order to get it to qualify. We have a training on DU, and you can watch that video. But basically, the other option is refer eligible, which is a manual underwrite. We're going to talk about manual underwrites here in a second. And then, like I said, improve ineligible means you're probably not running it correctly. You just need to tweak something. So we want to approve eligible, but sometimes we can't get it because of credit issues or debt ratio or something on the credit or something like that, typically. We're going to talk about manual underwriting because sometimes that does happen. We do manual underwrites. But I want to go back to making sure you guys understand how to calculate the debt ratios. I think the front end is pretty self-explanatory. The back end debt ratio, it's pretty simple math. Let's say that, the guy's got, $1,000 house payment, $500 car, 300 child support. So total equals 1,800. Right? And he's got 5,000 in income. So you take the outflow over the inflow, 1,800 divided by 5,000 equals 36%. Okay. So that is his total debt ratio for the back end. The 1,000 just for the house payment over the 5,000 income puts his debt ratio at 20%. Okay. So he'd be fine for any of the products that we offer, basically, if that was his situation. But remember that house payment includes his property taxes, insurance, and mortgage insurance, and if he has homeowners association or whatever. So now, on the couple things here you'll see with FHA here in the matrix. If the loan has a DU approval, which is the preferred, then you normally don't have to have rental history verified. Rental history is very important when you're buying a house. They want to check rental. But if you have the DU approval, then you normally don't have to have the rental history verified. If you have a manual underwrite, a downgraded manual underwrite, then they're going to want to check rental history. And here is where it says, what does this mean? 12-month rental, no private party. You know, let me fix that for a second. So if you have a manual underwrite loan and it can't get approved in the system, then you have to have 12 months of rental history. Private party means it can't be just a private person that's verifying the rent. You either have to, the buyer has to produce canceled checks every single month showing the rent payment, or it has to be through an institution like a company that's verifying the rental. Okay. They also, you know, are going to want to see reserves. Reserves are a reserve is the equivalent of 1 month of property taxes and insurance payments. Say again, here in this example, $1,000. So 3 months reserves, they want to see $3,000 in the bank. That's reserves, and you cannot use a gift for reserves. You can only use a gift for down payment. But if it's a manual underwrite, then they don't want to see a gift for the down payment. If it's a manual underwrite, because it weakens the file. Also, if there's a lot of derogatory, you need very strong letters of explanation on why this person has these issues on credit. Okay, it needs to be very strong letters of explanation to explain why they have these issues on credit. And if it's a manual underwrite, generally the max debt ratio is 43%, but there are expanded debt ratios that are allowed for FHA, and we're going to talk about here. I'll pull it up. We'll talk about expanded debt ratios for manual underwrites if you have some strong compensating factors, you know, and we'll go into that. Let's see here. That might be a good time to pull it up right now. Let me see if I have it here. I can pull it up for you. Okay. That's pulling up right now. Couple things here. Actually, this is good. Pull it up. We can talk about that. I'm just pulling up. I want to talk to you about the manual underwrite, some of the things with expanded debt ratios. We can talk about it. This is pulling up right now. Okay. And see, like your matrix has all this other stuff on it. Really good. So yeah, insufficient credit. If the borrower has thin credit, you know, ideally you want, you know, 3 trade lines. Sometimes if you don't have that and you have, you know, more money for reserves or long time on the job, that can help. You don't always need 3 credit lines. You're always looking for that, but sometimes it's okay if they don't. You can use alternate lines of credit, like, you know, if you have auto insurance, Netflix, you know, rental. And so now with rental, that can be actually added to the credit report through Rent Track. You can actually add that to the credit report. That can help to create a traded line. You can also open up a secured card or get an authorized user to be added with FHA. FHA doesn't have any issue at this current time with authorized user accounts. Basically, let's see here. There's some more stuff down there for you. There's some good stuff there with FHA. Let me see if this is ready. All right. I think that we can pull this up in here. Okay, I think it's right here. Yeah. All right. So like right here, on manual underwrites, and this has all been sent out to everybody. It's very important that you read this. But yes, the maximum debt to income ratio, like we said, is like 43%. Like I said here, you can go to 37 to 47 on the front and the back end with one of the following compensating factors. You have 3 months of cash reserves for 1 to 2 unit properties. If you're doing a 3 to 4 unit property, you need 6 months reserves. You have a minimal increase in the house payment, not greater than $100 or 5% of the previous monthly housing payment. So if your new house payment is less than $100, then your current, that could be a compensating factor. Also, this residual income calculation with the VA handbook, we have that basically after all your bills are paid, if you have income left over, that's according to that VA matrix, then that's a compensating factor. And that's basically saying, okay, after all my bills are paid, I have X amount left over, $500 a month for a single family person, then that can be used as a compensating factor. So yeah, I mean, basically, there's expanded ratios that are allowed with FHA. and there's different compensating factors. The higher ratios you go, the more compensating factors. Like here, you're going to need 2 compensating factors. If you go with 40 to 50%. So, and this has been sound. It's very powerful, and it can help you to bring in a lot of deals if you know what you're doing. But I definitely want to show that to you guys. So I thought it was very important that you saw that. A couple other things. Let's say here. Let's talk about if you're. Oh, we can talk about gift of equity. This is a good idea. Always want to find out when you're doing loans if the seller and buyer are related. Because if the seller and buyer are related, then you have the opportunity to do a FHA gift of equity, which is essentially, FHA zero down, where the seller is gifting the down payment and the closing costs to the buyer if the home has the equity in it. But they have to be related. It can't be friends. It has to be related. Somebody, either the buyer or the seller, have had to been occupying the home within the last 6 months. Okay, and they verify that with utility bills and copies of driver's license and stuff like that. They want to verify that stuff. And so they can literally gift the down payment if the home has the equity and the closing cost. If they're not occupying the home, then the max, it's what happens is they can still work, but instead of a 3.5% down requirement for the gift of equity, it's 15% down for the gift of equity. So the house would have to have a lot of equity for that to work if nobody was occupying the home. So basically how it works is, if this was a situation and you're going to construct it at zero down, then let's say that the seller wants to clear, they want to net $100,000. Net 100K. Then the closing costs are going to be, let's just say $5,000. The down payment's $3,500 or so. It's about 9%. So if I add that in, roll that up, 109,000 minus 8.5%, then that the seller will be netting 99,735. So you have to do the sales price on the contract for 109,000 approximately. So if seller wants a net, like I said, 100,000, you're going to have to do sales price equal to 109,000. Okay. And you deduct 5,000 for closing. Right. And 3,500 for down payment. So at the end of the day, the seller puts in their pocket the 100,000 they want. So when you write the sales contract, you do it for 109,000. Okay, that's on a gift of equity. So very important you ask that question if there's any relation to the seller and the buyer when they're buying a home. Because if it is, then you can potentially have that opportunity to use that program. What do you have? You want Capra? What do you got? You want Capra? You want, Capra or you want,
Did you like that? I can make a salad and something. Did you like that?
I'll meet you guys at the house. Um,
Daddy, what's your name on it? Daddy!
Roger, Roger. Next call, right now.
What? We're gonna leave my poster on there. You can't throw in the box. I'm no space to go.
guys want? And it's called the car, and then you guys want to go to the tiny island? You want that, tasting rice,
Grab on it.
All right, so let's go back and take a look at the couple things on with FHA. Now going in deeper into some of the guidelines. Talk about right now student loans, collections, disputed accounts, charge-offs. We take a look at a credit report today. So in regards to student loans, pretty much all the agencies have moved forward to adopting this philosophy or belief now of the 1% multiplier on the balance of the student loans. And so if you take if a borrower comes to you and they have 50,000 in student loan debt, and these student loans are deferred, and they're still in school, and they want to buy a house, then you have to hit them with this 1% multiplier times 1% equals $500 a month. That goes into the debt ratio. Okay. So that goes into the debt ratio, and they have to qualify with that. Now, there's a couple things they can do. They can enter into a fixed payment plan, like a 30-year payment plan, and if they did that like at a 2% interest rate, then the payment would be like $184 a month. So that would be a cheaper way to get them to qualify. They may qualify with a 1% multiplier for the mortgage they're trying to get, then that's fine. But if they don't, they may have to get those loans out of deferment and then put them into a fixed payment plan. Now, after closing, they can change it back if they need to go back into deferment. But the key thing here is that the Obama income-based repayments not allowed, graduated payments are not allowed. The only options are the 1% multiplier times the loan balance, or the fixed payment plan. Okay. So, so we'll take a look at that and see a couple other things on bankruptcies. The bankruptcy, for FHA, you have to be 2 years out from the discharge date. All right, that's for a Chapter 7. Chapter 7 is the total liquidation. Chapter 13, it's 1 year from the filing date, 12 months on-time payments. So Chapter 13 is the repayment plan. So they can literally buy a house or refinance 1 year from the filing date when they file the Chapter 13. If they have 12 months on-time payments, or they're 2 years from the discharge. Okay, so really cool to know that in case you ever come up with that type of situation. Now, let's take a look at collections and charge-off. I think that we're going to look at a credit report for an example, so you can get an idea of what it looks like in real life when you're looking at collections, charge-offs, disputed accounts, and stuff like that. So let's take a look. Let me clear this out. I think we have one here. pull it up. All right. It's right here. Okay. Yeah, here goes the credit report right here. And I think we can zoom into this too. Yeah. All right, so this is a credit report right here. We can take a look at to get an idea about how this all looks. Now, this is not a training on how to read a credit report. There's other trainings that we already have that teach you how to do that. But what I want to show you is, different things that, for instance, how collections, charge-offs, and how they affect, the FHA loan. So it shows right here. This is a charge-off. Okay, sometimes it'll show up here. Sometimes it'll show down here. For now, it shows up here. If it's a charge-off, then you don't include this into the debt ratio. It doesn't look good. Obviously, there's a balance. It's certainly not good, but and it was recent. But it's not a collection. It's a charge-off. That means that this is the Wells Fargo was the original creditor, and the account's been charged off by them. The collection is when it would go to, like Midland Funding, the collection agency, and then that would we're going to talk about that here in a second, how that affects the ratios. But charge-offs aren't factored into it. Let's see here, and usually I remember on things on a credit report they highlight in yellow if it's derogatory. This here shows that the dispute was resolved, so this account is not in dispute. This account is in dispute. It says it right there. Account information is disputed by a consumer. Now remember, borrower is the primary borrower. This is the co-borrower. This is the credit report that we're using, Experian. And yeah, this is the date of last activity. I want to go back and show you that on the matrix real quick, though. So on collections and charge-offs, it says not charge-offs, if you see. So it says right here, $2,000 greater than 5%. Okay. So if a person has cumulative greater than $2,000, and that can include a non-borrowing spouse in a community property state, you have to drag in their collections too. If it exceeds $2,000, now this is non-medical. This excludes medical, guys. Then that you hit them with a 5% multiplier. So let's just go through this credit report and see if we see that situation here. This is a charge-off. And this is a community property state. I think we're dealing with Nevada. And so we're going to look at all the delinquency. This is child support. That's already going to be put into the debt ratio. This one's being paid as agreed. This is a collection, closed collection. So that's $112. Boom. Is there anything else? No, not up there. These are all zeroed out. Means they've been paid off. It's been paid off. All these are zeroed out. Disputes that are paid off, they don't count. They don't apply even if it's still open. It's been paid off. This is public record. You always want to check that. Shows that it's been satisfied. So looks like they don't have the 2,000 or greater in collections. If they did, then the way it works is you would take 2,000 times 5%, and that equals $100. Okay, so that goes into the debt ratio. Now, if they pay the accounts below 2,000, then it doesn't have to go into the debt ratio. They can pay them below. So you're just going to have to check and see when you're qualifying the person if they can still qualify. If you don't want them to pay off the collections. Remember, charge-offs do not count. And then also medical collections do not count either for FHA. And these for a community property state, if the non-borrowing spouse has those collections, those have to be factored in as well. Don't forget that. And let's see here. The other option they can do, and that's what the guidelines are saying, is that you can enter into a 3-month payment plan, but you cannot prepay the payment plan. Okay, they have to literally enter into the payment plan. Whatever that payment is, you would put that into the debt ratio. Foreclosures are 3 years out. Now this is important, guys, on foreclosures and short sales. Now you don't go off of the credit report, the date of last activity for foreclosures. You need to check and see. It says there from the trustee's deed recorded date sale. So what happens is that after the house goes into foreclosure, the deed transfers back from the homeowner back to the bank, and they want to know the date that happened, and that the claim was paid. So you call FHA Connection. Okay. And find out with that borrower's information when the claim was paid and when they're eligible for an FHA loan. Okay, and also you can run CAVers, get with your loan processor to run CAVers. Pull up here. Basically, it's a list of, credit alert verification system. If you ever taken out a federal loan, and if you've defaulted on a report in the system, will show up if you've ever defaulted. You have to clear that CAVers, and with FHA Connections, find out whenever when they paid the claim and when you're eligible again for another FHA loan. So check that. Don't go off of the credit report. Check this. Be smart, okay? And why are we telling you all this, guys? Because so you want to make a lot of money, you need to know what you're doing. If you don't know what you're doing, you're not going to make a lot of money. You're going to be wasting time pre-approving the wrong people that don't qualify for a loan, or they're not ready yet because you're not studying the guidelines. So you got to know this stuff. You really got to know it. Okay. With FHA loans, they typically take about 30 days to close. Is realistic. Sometimes they can take longer. If it's a 203K or escrow repair, if it has minor repair work, you might add a couple weeks to it. If the house has a well and septic, you're going to need sanitation inspections for that. They run about $100, somewhere around there. Appraisals, typically run about $500 for an FHA appraisal. We do have a matrix on the pre-approved checklist. We're going to talk about that today on how to determine concessions. One thing with FHA loans, if you're using fixed income, like Social Security, it shows right here, you can gross it up, 15%. What that means is because it's non-taxable income, you can gross it up. So if the person's getting $1,000 a month of Social Security that's not taxed, and you can check on their tax return, if it's not claimed or the portion that is claimed is $1,000 and the other part is tax that's over $1,000, you can use the $1,000 part. Then you can gross that up 15%. So their income would be $1,150, and you can do this for non-taxable income, not just SSI. It could be for disability, some pensions. And so it's really cool because it can help to boost the income for qualification. And this is here in the matrix as well. So what else? I want to go back to this credit report. Let's see. I thought there were some other things on that matrix I want to talk about. Let me just make sure. Oh yeah, disputed accounts. Okay. So yes, disputed accounts. So with FHA, the cumulative discounts and dispute cumulative, not each account. And now this is excludes medical. So see, it excludes medical. So if the student loans, I'm sorry, if the disputed accounts are greater than $1,000 cumulative, then it downgrades it to a manual underwrite. Okay, and you don't want that really. So you want to take a look at that credit report. We're going to go back and check it out again. We saw there was an account dispute. Now, if the account's paid off, it doesn't matter. If it's medical, it doesn't matter for FHA. So this has been this one right here has been resolved, so it's fine. But this one right here is still in dispute, and it has a balance. So we need this person to remove this out of dispute or pay it down below 1,000, so she can still use approve eligible for DU. You can't leave it like this on the credit report. It needs to be taken out of dispute. She would contact, the credit bureau repositories, Experian, TransUnion, Equifax, and get it removed, or just simply pay it down below 1,000. Either one. But you couldn't leave it in that state because it'd be a manual underwrite. You don't want that right now. So for qualifying. So just FYI. So we see that on this person's credit report. A couple other things I want to talk to you about. If the person had, one thing sometimes you see, it's not prevalent on this person's credit report, but if somebody had an installment loan that you were trying to omit, it only applies for installment loans. If somebody had those, then they could potentially be omitted from the debt ratio if they were below 10 payments. Not revolving accounts. So right here, this is an installment loan. So let's just say that it has to be a secure. In order to do this, it has to be a secured installment loan. So let me explain to you how this works. I'll make it clear. If our borrower makes, 5,000 income, right? And their payment on Daniel's Home Center, let's assume that this is a secured installment. Normally it'll say secured here. You can check with the creditor to find out if it's secured. If it's unsecured, then we can't omit it. But let's just say that, the payment was, 150. Right? And the balance was 1,200. Well, if you multiply 150 times 10, it's below 10 months of payments. So you're thinking, well, yeah, I can just omit it. Well, in order to do that, first off, it has to be secured. And the second thing is it has to be below 5% of their gross earnings. So you would multiply 5,000 times 5% equals 250. So as long as this payment is below, this payment here is below this here, then you can omit it. You can omit this debt. But if this payment was 350, you can't omit it. Okay? Because the payment's greater than the 5% of his income. So it's very important that you pay attention to these type of details because it's going to make all the difference on if you can get the loan through or not and how it's structured. So this is where we're talking about being a master and going to the next steps on being able to learn how to structure loans properly. Now let's go take a look at the pre-approved checklist. I want to show you before you ever pre-approve somebody, this is the checklist that you're going to check to make sure that the person's pre-approved. We have a whole training on this. These are things that you're going to be checking for to ensure that the person qualifies for the loan. Now concessions are right here. They show you what to use as an approximation of what's needed. Now this is not 100% or so you're always going to need this, but it's a guide. It's a good guide to use. So come here and check this to make sure that that before you pre-approve someone that you go off this checklist to make sure that they qualify. It's really important that you do that. You can go through it because if you overlook something, it could cost you from closing on a loan. And we don't have time to waste on that. So use your pre-approved checklist and have a manager check it out just to make sure. Also, when you're pre-approving somebody, when you're getting ready to turn the loan into processing, this is the red light checklist. And this needs to be filled out and completed by you. You put in the information here, the borrower, put the information, check it all off. And take the time to do it. And if you follow this wholeheartedly and you're serious about it, then you're going to turn in good loans that close. Okay, how old is the credit report? It has to be less, if it's below, if it's over 120 days, you got to pull another credit report. If your loan's going to close and it's going to be over 120 days by the time that you close, pull a new credit report. You have most recent pay stubs in the file, most recent bank statements. Are you using MCC? Did you account for that? What are the credit scores? Is your contract correct with a correct close date? Correct concessions. How much do you have in reserves? What are the ratios? Do you have have you verified funds for down payment? Okay, so if you pass this off to anyone else, your loan will not close and you will not make the money here, and you will have a very hard time working here, and most likely, if you don't change, will be removed from the system. Okay, you have to take this time to do this and make sure that you're turning in good loans if you want to be successful. Follow this checklist. Do you have the tax returns? Do you have the pay stubs? If you can't control your borrower to get these things in, then you're not going to be successful. You have to get these items in. Get the realtor involved. Do whatever you got to do to get these items in. You have the bank statements. If you're using transfer from the 401k, make sure you have that documented. There's a sales contract with an attainable closing date. Do you have the homeowner's insurance quote? Does the house have a well and septic? Check these things out, guys. It's going to make all the difference. Should go through the credit. Is there any bankruptcy? Do you have the letters of explanation? Foreclosure, the short sale, all these things. And if it's in there, processing and management is not clean up loans. That's your responsibility. It comes with your opportunity here to work here. You got to go through this to check and make sure that these things are in the file. So go through this checklist. If you're doing we're not going to talk about USDA right now, but If you have accounts in disputes, any late payments within the last 12 months, you better have a very strong letter of explanation. If the person's been divorced, you need divorce decrees, bankruptcy discharge. If there's child support, you need child support, attorney general or court order showing the payments. You know, you need to make sure that we have that in the file. Now, let's see here. I think that, what else? Let's see, I think now we're going to go move into, we talked about a lot of very good content today. I want to talk about the FHA cash out and streamline. So, let's close out of some of this stuff. Okay. Okay. What is FHA streamline loan? Well, streamline, if you think about what streamline means, it means like expedited, simplified, right? That's what streamline is. And so this is for people that they already have an FHA loan. They don't have a USDA loan. They don't have a conventional loan. They have an FHA loan already. Okay, that's what this is saying right here. It's for people that have an existing FHA mortgage. Okay, and it waives the documentation that's required to get the loan. And they change all the time. It's not like it just stays. This is one thing about this business, everything changes all the time. That's the only thing I can promise you is that change is inevitable and it's going to happen. Basically, the benefit of why do it is it's, let's say that you did an FHA loan, you bought a house 3 years ago, the interest rate was 6%, and you want to take advantage of low rates today, and now the rate's at 3%, where you can refinance. Now you cannot take out any cash. This is only, you're just refinancing to lower your interest rate. So, and there's no, you don't need an appraisal. Okay, and you don't have to pay for an appraisal, and you know, you also, you look down here, like it says, no verification of job, income, or credit. So that's huge. You don't have to go back and check the verification of job, income, or credit. So employment verification not required, income verification not required, credit score verification not required. They do check the mortgage payment history. So you have to be on time with the mortgage. If you're not on time, then you're not eligible for a streamline refinance. And there has to be a benefit. You have to at least be lowering your payment by 5% or more, qualify for an FHA streamline refinance. And you can go from a 30-year to a 15-year. That's fine. You know, that's good. Now with the streamline refinance, you can't exceed your original principal balance. So if you close for it with $100,000 loan, you can't exceed that. You have to stay below that original principal balance. Now, a couple things here. You can do a fixed or adjustable rate. You know, most people just do a fixed rate, and there's not really people are going to do an adjustable rate. There's no prepayment penalty with FHA. See here. Let's see. Well, this says here that one mortgage payment is acceptable, one late payment. I mean, I guess that could potentially be okay. You'd have to check with the underwriter to find out. Yeah, and you do have to make at least 6 mortgage payments before you can do a streamlined refinance. I think it says must have a purpose and that tangible benefit. They do check that. Yeah, increasing. Okay. So yes, the closing costs cannot be included though in the loan. You cannot roll up the closing costs into the loan, and you can give a lender credit to help cover the closing costs. If you're going to roll the closing costs into the loan, then you're going to have to order an appraisal and do a full FHA refinance. And so the thing that I want to make sure you guys understand that when you're doing a refinance, you're not putting money down because they already own the home and they most likely have equity in the home. Now, if the house doesn't have equity, like if the home is worth 100,000, the value, and they owe 110K, well then they're upside down. They owe 110, it's worth 100. They have negative 10K equity. So they would have to bring this money to closing because they're short. They're upside down on the deal. So that's not obviously a good spot or desirable spot where you want to be. Sometimes that happens, not too often in our marketplace, but it can happen. So remember, this is for people that already have an FHA loan. They're doing a streamlined refinancing to a current FHA loan. They can't include closing costs. Now, again, you could give them maybe a lender credit, but if you give them a lender credit, then that means the rate's going to be higher. So they're coming to you to refinance to lower the rate. So, giving them a lender credit by raising the interest rate, it may benefit them, but we have to look and see what the pricing looks like, see if that even makes sense. So you definitely want to check that out just to make sure that that's going to work. That's really important. What else? Let's see. So that's an FHA streamlined refinance. So that way you can just explain it. So please check this out and make sure you understand that. You can check it out here. And I mean, all this stuff's available online, obviously. Now, FHA refinance cash out is different. An FHA refinance, they can pull out equity to pay off bills. Okay. So now, the only thing is with FHA refinance cash out, it's prohibited in the state of Texas. It's available everywhere else, all other 49 states except Texas. So if you're in any other state, you can do a refinance cash out. You can do an FHA streamline in Texas, but not an FHA cash out. So it's important to understand the difference. So I'm going to do some examples here on the cash out to show you to explain and illustrate the differences. Cash outs are cool. That's how I started in the business. I really like them, and I think you will too. It's shorter closing time than a purchase because there's no realtor, there's no contract. They already own the house, and it's very beneficial for them too. You get a lot of scenarios, and people want to pull out cash, and they, it's an asset. They can pull out, money from their piggy bank and use the equity to fund transactions, pay off tax liens, pay off credit cards, pay off boats, pay off cars, pay off judgments, fix up the house, all kinds of things. Now, The thing is that you're limited to 85% of the appraisal with an FHA cash out debt consolidation program, or whatever cash out they're going to be doing. It doesn't have to be for debt consolidation. But the way it works is, let's say that, you know, you have a customer and you have 200,000 in value. The home's worth 200,000, and he calls me up. He says, "Hey, Angelo, I want to refinance cash out. I got a bunch of debt and I owe the IRS some money. You know, I need some help here." I mean, you're going to know the most he can go up to is 85% of the appraisal. Okay, so you do 200,000 multiplied by 85%. That's equals 170. That's the most his loan can go to with closing costs and everything included. Okay, if he owes, you know, 100,000, that's what he owes. Okay, on the mortgage, and he has credit cards equal 20K. And it's important to find out how much the payments are on all this stuff. He's paying P equals 800, P equals 700, IRS 40K. That's a big one. Don't want that in your life. P equals 1100, right? And this happens all the time. You know, you're going to get situations like this all the time. It's not unusual. Okay. So you know that the most you can go to, and the 200,000, where do we get that? He's checked comps in the area. He talked to a realtor. We don't know for sure. This is an estimate right now. Nothing's for sure right now. But what we do know is that we can only go to 85% of the appraisal. So, which is 170. So that's the most loan we can go to. So if he owes 100, I'm going to add 20,000 for the credit cards. I'm going to add 40,000 for the IRS. So that's 100 plus 20 plus 40. That's 160. I'm still below 170. Now I know closing costs on 170 are probably going to be about, you know, about 6,000 based off of my closing costs chart. So I'm good. I can fit all this in and pay it all off. And this guy's paying 1,100 for this, 700 for that, 800 for that. That's 1,500 plus 1,100. This guy's paying 2,600 a month. Okay, so we're going to give him a lot of breathing room, and we'll be able to roll his closing costs into the loan, pay off all this debt, and give him one low monthly payment. So now he can consolidate on a 30-year fixed mortgage at a 4% interest rate today and get a payment of $792. So right now he's paying $2,600. New payment equals $792. Okay, so he's saving the difference, which is $1,808 a month. Okay, which is insane. That's ridiculous. That's life changing. This guy's saving, you know, $21,696 a year by doing this deal. Okay, if you can't sell that, then you have no business selling. You know. Now, you know, sometimes people say, well, Angelo, we're starting all over. We're going back to a 30-year loan. Well, yeah, you are, but I'm putting you in a better financial position today, so you can breathe, and now you freed up a ton of money, and you can plug in that $1,800 into an investment to buy another house, a rental property, or apartment, or paying down more debt somewhere else. like reapply it back to the mortgage. You know, if you take out this loan for 30 years at 4%, the payment's 792, and you plug in, you just add another 1,000 to the payment. You know, let's see what it's going to do to you. It's going to save you. It's going to trim that mortgage down. It's going to take it to a 9-year loan. So if you just add 1,000 to the payment, you freed up 1,800. You just add 1,000 to mortgage. Then payoff is in 9 years. Okay, and you can just do that off on your calculator. So, and he had 16 years left anyway, so he's in a better situation. That's just with 1,000 that he freed up. So it's a no-brainer, guys. It really is. And so remember, you can do FHA cash outs in 49 states, every state except Texas. You can do a conventional cash out in Texas. Closing costs are included. Remember, closing times can be faster. It's an easier process because there's no searching a house, hunting down a home, realtors, and all that mess. It's just a simple, and it's usually a huge benefit to everybody. It's really a win-win situation. They're really, really good, beneficial. I've done tons of them, and how I started in the industry. I really enjoy them. I think it's a great program. I've helped a lot of people with them. So definitely want to be looking, and that's how you explain to someone. You want to work it up, and then, when you're talking to these type of customers, you want to be able to send that to them in writing to show them how it's going to help them. Debt consolidation or whatever they're doing with the money. If they're taking out the money for investments or improvements. I mean, there's a lot of different things, but you have to know how to build value and educate the customer on what you're going to be doing in the financial plan if you want to be successful. If you don't do this, you're not going to get the loan in, and then you're going to go broke. So make sure you really, really understand what you're doing here, so that way you have the best opportunity to win. It's just extremely, extremely important. Now, lastly, what we're going to be talking about is escrow repair loans. And so these do come up quite often, and I want to be able to educate you on how they work, because a lot of people inquire about them, and you want to know how to discuss them when people inquire about an escrow repair. So we'll talk about those here now. So I'll go over them with you, okay? All right. So on the escrow repair, basically it's an FHA 203B loan. So regular, standard 203B. The difference is with this program, it's where somebody's buying a house, and the house it requires some type of repairs, minor repairs. This is not structural, foundational, or cosmetic. I'll repeat that. This is not structural, foundation, or cosmetic. So if the buyer says, well, I just want to change out the carpet, I don't like the way the carpet looks, you can't do it for that. Okay. He says, well, I don't like the cabinets, I want to change out the cabinets, you can't do it for that. Okay. If the house has a cracked foundation, you can't do it for that. Have structural problems, can't do it for that. Those are different renovation loan programs, not an escrow repair. This is for something that has minor requirements, like it needs a new air conditioner. It needs flooring because it has no floor. It needs cabinets or countertops because it has none. It's a foreclosure and it got a little bit messed up. It needs has broken windows. With FHA, by the way, any busted siding or broken windows, that's got to get fixed. Handrails that are ripped off, a porch that has that's torn up has to get fixed. You can't have any of those type of issues with an FHA loan. And so basically, and this is what it talks about here. For rules for escrow repair, it allows you to purchase the home, with it needs those repairs. And they have to be done within 30 days. You have to get a bid from a contractor for the repair work. And so there's a limit. We allow up to 5,000. It can be, yes, for exterior, interior work. Now this says 90 days. I believe that we're at 30 days. I'll double check that to have the work done. And basically whatever the amount of the bid is for the repair, we have to put 50%. We have to put 50%. The buyer does, or the buyer or seller has to put 50% in reserve or an escrow to cover those repair items. And so what I mean by that, let me just explain to you how it works. Let's see here. And then once the work is done, we have to go back and inspect the work. So let me explain to you how this works so you can understand this. So let's say that you get a deal where they want to buy the house for $100,000. Okay, $100,000 home, and needs 5,000, 5K repairs. Okay, the house has to appraise out. If they're putting 3.5% down, that's 96,500 plus the 5,000. It has to appraise out for the amount of the repairs with the loan, so it would have to be for like 103. You can't appraise just for the 100 because now you're adding the 5,000 for the repairs. Assuming the seller's not doing the escrow repair that the buyer is. Now the seller can do it and come out of his proceeds, and that's fine. But assuming that the buyer does it, then you want to make these as clean as possible. So either the seller is going to do it or the buyer is going to do it, or they can chip in and both do it. You only want one contractor to give the bid. You're not going to do multiple contractors. And basically, the way it works is, let's just say, assume that the buyer is going to do in this example, they have to put up 50% of this 5,000 in reserve. So 2,500 has to go up in reserve now, and they still have to put their 3.5% down for the down payment. So basically, they have to put this up in escrow. And so now their earnest money that they've already put up is factored into that. So if they put up 1,000 in earnest money, then they only have to put up 1,500. But then they still have to put the full 3.5% for the down payment. So this is just a contingency fee, just in case there's an overage with the repair work. Okay, and so now what will happen is that they'll get the bid from the contractor, and the contractor will come out and do the work. And if the job's done after the final inspection is done, the buyer has to pay for the final inspection. I think it's about $150 or so. Once that's done, then and they didn't use that $2,500, then that can be refunded back to the buyer after closing. Obviously, this is after they've already closed on the loan and the work's done. But if they go over, then they pull from that. Okay, so that's why that's there. And that can be put up by the seller. That can be put up by the buyer. But you want to make sure that we have that there in place. I'm just reading to see if there's anything else that, and some companies have different requirements. We might be able to go up to 90 days. I got to check and see on that. I think it's 30, but we'll find out for sure what that is. So yeah, like roof foundation, structure, stuff like that is not allowed. It's going to be for more minor items, but definitely not cosmetic. So it can come in very handy because you see a lot of different properties that require different. There's problems with them. They were foreclosed on, and most banks don't want to mess with them. They don't want to do them. We do them, and we've done them very well. We know how to do them. So when someone comes to us and asks for it, we don't have an issue. But they just have to follow these guidelines and make sure that there's not. Also, one thing that's very important: the utilities have to be able to be on. They have to be on. If you can't get the utilities on, it's a foreclosure. It's not going to work. You have to be able to get the utilities on. If you can't get the utilities on, you can't do a 203B loan. You have to go to a 203K. So that's a really important thing. Make sure that you understand that when you're doing a 203B and especially an S for repair, that you have to have the utilities on if it's foreclosure, because we have to check for that. So anyway, these are some very important tips to help you with an FHA loan, to understand how to do all the different types of FHA loans and the main ones that we do. I hope that this was educational for you and help you to understand a little bit better about how to structure FHA loans, and help you with increasing your income, get deals closed, help people to become homeowners or refinance them by better understanding the guidelines. So please watch this video several times to educate yourself on it to get better and sharper. Okay, thank you. Bye.